So you're going to lose the inflation rate, and you're going to get less. You'll pay if you do a 2-year, you're essentially going to pay 104,000 to get 100,000 back, or you'll buy 100,000 bonds and get 94 back in 2 years' time. That's expensive, and that makes gold look cheap. Buffett criticized gold for not paying a yield. No. When you're paying a negative yield, not paying a yield becomes a feature, a benefit. And that's why I'll say, even though there's a pullback right now in gold, go and look at the Swissy gold chart, and I consider the Swiss franc probably one of the more semi-serious fiats. Go and look at the Swissy gold chart. We've just made some number of macro targets. There will be a slight pullback, but it's going to go higher in my view.
Switzerland's 10-year bond yield was 0.28% on Monday, May 19th, according to over-the-counter interbank yield quotes for this government bond maturity. Historically, the Switzerland 10-year government bond yield reached an all-time high of 5.63% in September 1994. Given the bond market's massive size relative to the gold market, even modest shifts in capital allocation can generate substantial price movements in gold. This dynamic explains why negative real rate environments have historically coincided with significant gold price appreciation. Market analyst FrancisHunt explains that with Swiss short-term bonds offering negative real returns, investors are effectively locking in losses. In this context, Hunt argues gold shines in a world of negative yields, turning its lack of interest into an advantage. Gold was the star performer for the SNB, registering a valuation gain of 12.8 billion francs in the 3 months to the end of March. The gain compensated for a 5.3 billion franc loss the SNB from its foreign currency positions due to price losses on the stocks and bonds it holds. UBS economist Alessandro B. estimates the SNB has lost 50 billion francs in the value of its assets since the end of March, due to a rising franc and declines in U.S. bonds and equities following President Donald Trump's tariff announcements. According to FrancisHunt, the recession forecast volatility reflects real market shocks, especially during the peak Trump tariff tantrum. He notes the unusual combination of falling bond yields, rising interest rates, and a weakening dollar. President Donald Trump's move to defuse an ugly trade war with China not only sparked a massive stock market rally, but also drove down the chances of a recession for now. While reflecting on major fundamentals, Hunt warns that the current market calm is misleading, with core issues still unresolved. Regarding global capital flows, Hunt predicts a shift away from U.S. assets toward emerging markets due to lost trust. He views gold and select international equities as safer long-term bets. Before we dive into FrancisHunt's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the markets. Let's get into it.
There's a reason there's been real volatility in the predictions, and that's because we had real volatility. We had an earth-shuddering moment, and the key earth-shuddering moment came about, Kai, is when peak Trump tariff tantrum. What actually happened is the bond market collapsed, rates shot up, and the dollar went down. That was the first time that ever happened meaningfully in the US. By the way, it fulfilled the prediction that we'd made when the same thing happened in the UK, something I'll be reminding people in our chat as well with, when they had the pension crisis. Everybody thinks rates up, your currency goes up. Normally that's the case. When you are having a complete loss of faith moment, as was experienced then, it was earth-shattering and very much shook the American wedding party, let's just say. And at that point, while that happened, you saw a flight out of dollar and a flight out of treasuries. And that was a very, very short, sharp slap on the face for Donald Trump, which he later said, I wasn't afraid about the bond market, which I interpret to mean he was afraid about the bond market. Or someone who explained it to him told him he should have been afraid about the bond market. So suddenly they reined that very harshly back and renormalized. So during the period while we were in that peak de-dollarization, suddenly isolationist American moment, he suddenly came back out and said, let's make friends, let's work together all again. And they quickly reversed back that line. So it was they tested the line, they got a very hard slap. Now, a lot of those predictions of 90% recession for the US were being made in the heat of dollar losing value and the bonds losing value simultaneously. Now, suddenly, the ability they've shown to actually reflate and normalize, which has been quite spectacular as well, has seen everybody rein it back. So everyone panicked with the panic, and everybody's gone, hey, we're back to everything hunky-dory. Neither is right. The people that are thinking they're back to hunky-dory, you just saw a flash of the future in a small microcosm moment. That comes back again. So remember, the guy who predicted it when it happened in the UK, that said it's coming for America, it's happened once, you've had 5 minutes of it. Now wait till you have a full day. Now wait till you have a full week of it. It will come back. So I'm afraid that this is the beginning of drama and a first test. It's a fight where we've stood each other off in the pub, Kai, and you thought I was a wimp, and you marched right up in my face, and then next thing you know, I gave you a short, sharp slap.
You're good in judo.
And then you got over your slap, and you thought, okay, hang on, you had another beer, and you got strong again, and you're coming back at me, and this time I'm going for the Jedi 5-finger punch to your chest. So that's the scenario where, and I think everybody thinks, that it was all over, and that it's back to normalization, and we can rein this all back. It isn't. So just to deal with that measure on the Swiss, it's the short end, first of all. So it's 1 and 2 years that have just dipped negative again. And that is a sign of distress. So what that means is really afraid people are prepared to guaranteed accept less money back in 1 or 2 years' time than they give you. Plus, Switzerland still has an inflation rate. It's between 1.3 and 2.2, depending on any given year. That's according to their statist exemplar of stats, which I'll never trust on any nation. But anyway, it's there or thereabouts, let's just say. Let's take them at their word. So you're going to lose the inflation rate and you're going to get less. You'll pay if you do a 2 year, you're essentially going to pay 104,000 to get 100,000 back, or you'll buy 100,000 bonds and get 94 back in 2 years' time. That's expensive, and that makes gold look cheap. Buffett criticized gold for not paying a yield. No. When you're paying a negative yield, not paying a yield becomes a feature, a benefit. And that's why I'll say, even though there's a pullback right now in gold, go and look at the Swissy gold chart, and I consider the Swiss franc probably one of the more semi-serious fiats. Go and look at the Swissy gold chart. We've just made some number of macro targets. There will be a slight pullback, but it's going to go higher in my view. So history is quite binary. Your bonds or your stocks. When you risk on, you run into stocks. When you're afraid, risk off, you run into bonds. It's quite binary, and people are being traded in that. That's the 60-40 portfolio. That programming is going to take a while to unfurl. So initially, right now, that long bonds are being sold off, and everybody realizes Druckenmiller and Tudor Jones have been short and have been building a short position that they're now disclosing in November last year. They probably did it the whole year, getting their positions on. Now everybody thinks, okay, maybe we should be following suit. So the natural flow is often equities to start. But if you become really worried and you want to stay in bonds, you go to a country like Switzerland on the short end, which is what we just described. That's an illustration of stress and fear about return of capital instead of return on capital. But the smart will really say, bonds isn't the game. It's a crap product. No matter where you buy it, you're either not getting paid enough yield or your risk of default isn't fully priced in. That's why we're seeing the long ends continue to price up, because the risk of default is far more critical and likely to happen. So bonds is the worst investment anywhere you do it, in my opinion. Long, short end, any nation, stay out. And what tends to happen is, okay, where's the reserve asset? And that's why I say gold will benefit. We've seen a little bit of a better performance from crypto. It's a much smaller market cap, but there's some flows in there. And that's what. And there's equities.
But that's more of a risk-on asset. Sorry to jump in.
It is a risk-on asset. Yeah, it is a risk-on asset, but it's being treated slightly differently because its time as a future waiting in the wings, waiting for the new system, is now coming. It's going to get a spotlight appearance where it has a bit of Midas feel about it. It has a messianic moment. And gold is in that same spotlight as well, but has already really, really run. So as gold maybe rests, I think maybe a little bit of the spot will fall on crypto. And of course, the Pavlovian response of running into equities is still there, but it's the wrong one. It's the outdated. You're coming out in your 80s fashion. You're wearing your leg warmers and going to Jane Fonda classes if you're still rushing into equities right now. That's my take. If you look at the market caps of the US relative to the rest of the world, my net opinion is those relative market caps are going to come chronically down in America, and you're going to see other market caps. I see indices going up in emerging markets. I see it in Singapore. I see it in other capital formation nations. America's going to lose market cap to the rest of the world in equity. So I think there'll be a geographical flow. If we're just staying in equities, there's going to be a geographical flow away from the US still because of the tariff. You can only scare people like they did with the tariff tantrum once, and trust is eroded. They did long-term damage on trust there.
Regarding the illusion of low CPI, FrancisHunt argues that it results from artificial disruptions, such as Trump's tariff embargo and Saudi oil oversupply, rather than genuine economic strength. He emphasizes we're in a debt-based collapse masked by manipulated inflation signals. The Fed, boxed in by unsustainable debt levels, can't cut rates despite recessionary conditions. Against this more optimistic backdrop, JP Morgan Research expects the Fed to hold policy rates steady over the medium term, with the next rate cut likely only taking place in December, provided that current tariff rates remain in place indefinitely. Looking at global debt markets, Hunt warns a collapse is looming as bond demand dries up. He views gold as a safe haven amid the coming currency and debt devaluation. Recent cycles of inflation, growing global debt burdens, and increasing geopolitical tensions have only strengthened the case for precious metals. The evidence is evident, with the U.S. national debt exceeding $35 trillion and global central banks actively diversifying their reserves with record-high gold purchases. The dollar's 87% decline since 1971 is a stark reminder that fiat currencies are not reliable long-term stores of value. Let's get back to the interview.
I'll even take you before April the 2nd, before answering the April the 2nd bit. We're in a debt-based collapse. It's the foundation stone of everything that's going down. So you have a recent low print on CPI. Our basic scenario is stagflationary. And many people have come back at us and said, oh, but look, the low CPI number. And what happened during that time? We had a tariff, Trump's tariff tantrum, where essentially he stopped containers. It's almost like mini lockdown.
Yeah, they called it an embargo, actually. I think Besant even said embargo.
100%. They stopped containers, which obviously is going to affect consumption and is going to lead to those low CPI numbers. More importantly, we had the Saudis decide to increase supply, and then further, today, we see in June they intend to further surge their oil supply. So why? In a recessionary environment where goods haven't been provided, where there's a downturn in demand, we're hearing about record bankruptcies in the States, record levels of, they call it the 90-day in bad state of repair credit card, automotive, and housing. All at literally new highs. And you've got all that environment, and people are saying, yeah, you see, but the low CPI, we're not going to stagflate. So in that environment, why would the Saudis be pumping more oil? They've got to keep the inflation tax. Oil is a multiplier in inflation. It's in everything, as you're well aware. Delivery, you name it, travel, business, commercial, holidays, everything you buy, everything you do, packaging, 100%, breaking ground, whatever you do. So it is an absolute. So if they get disproportionate supply demand, they put downward pressure on oil. We were the guys that told you a couple of times on when we've appeared on your show, long gold, short oil, because essentially we're in a consumer retail-based, in recessionary type environment, while in that same time we're getting a debt-based collapse, referring you to my opening statement, which means we need a new reserve asset. Let's go back to the old reserve asset, aka gold. The other key point is those long-term debt percentages are going up across the board, with the possible exception of China and Switzerland. You're looking at the 10-year, the 20 years, and the 30 years, all going higher on rates. What is that? Debt devaluation. That's going to kill the housing markets. This is we referred to the massive amount of rejections on refinance applications in the States, 42%, 36%. Nobody wants to originate a debt instrument asset anymore by letting people borrow. And at the same time, the existing assets on the long, which are on long debt, are actually, we've got the curve steepening, and the rates are going up. So the asset is devaluing immensely. So that's what's going on. And you've then had the stop in the economy. I call it the effect of a mini lockdown. You can call it an embargo. It has a similar effect. So you get a low inflationary read. It's trying to massage the numbers. The Saudis are in cahoots. They will be compensated for doing not-for-profit selling, and they are being compensated in many, many, many ways. They're becoming the entertainment hub. Well, the Middle East, the Arab Emirates, let's not be too specific. You're getting all the football there. As I was joking with you, they don't play rugby, and they're already down for after Australia to host the next Rugby World Cup in the desert somewhere. All of these things are being crowded into that area. You had Elon moving Neuralink lab to Dubai. All of this is happening. I actually think you're seeing the tech hub that Silicon Valley once was, in part being slowly bled out. And Trump is enabling this. So everyone who thinks he's MAGA and make America great should maybe think again, because his big pals with the Saudi Arab Emirates is normalizing this society, as they are seeing it as a coronation in terms of the significance of their region in the area. Well, when you say the Fed, everybody assumes that the Fed gets to determine the interest rates. And again, I refer you to literally the opening state. It's a debt-based collapse. Because for the Fed to be able to set the rates lower, you're actually saying, well, this asset is now worth more. And there's an absolute plethora of it. They've got $9 trillion to roll. They haven't, that's not including the additional expenditure that are gone. In truth, the doggy savings that you've been told about are minuscule. And if you look at it in a big time frame curve, there's no real meaningful adjustment. Not that I'm going to say if any efficiency is a bad thing and culling a lot of the bulk products, but this is nickel and diming. It's saving, it's pence.
You're saving 10% or whatever it is.
Pence wise and pound foolish. The big money is the problem. And so as a result of that, he doesn't have the power to cut rates. In fact, the Fed's never been more clearly boxed in. They need, actually, for the debt to be devalued, they should, on that behalf, be comfortable with raising rates. Think a Volcker upswing that was at the 80s. But in terms of the economic health of the consumer and the nation and the state of bankruptcy that I imagine many consumers are in, many municipalities are in, many states are in, they can't actually do those cuts because there's no bid on the debt. So this is all about the reserve assets that was afforded to bonds that ended with the 40-year bull market. He doesn't have the power. He's boxed in. The gravitas of this is far larger than people seem to realize. It feels like everybody is a zombie. It's kind of like I'm saying a Richter scale 10 earthquake is going to hit the entire planet. And everybody's going, yeah, okay, what time's we going down to the pub? It's far greater scale. It's the foundation of finance, debt markets. And the debt markets universally in the Western nations, with the possible exception of the Swiss, as I've mentioned already, in a chronic state of revaluation. The rates going up. Everybody thinks there's rate cuts coming. They don't realize the Fed doesn't control that if there isn't the demand for the bonds. You can't price something at a price nobody wants it at. And that's the problem. And they know that. Markets, in the end, eventually get to say. And at the moment, they're talking and people don't want bonds. Not only that, Americans themselves are positioning short on American debt. If the debt markets are going to fail, everything that is leveraged, everything that has any form of leverage, and you'll be shocked how many things that touches, housing, cars, everything you buy, stores, it's going to collapse. Retail, you're going to have a right sizing of the demand curve once debt gets devalued. And this is huge. This is global depression material. That's where we're at. And at the same time, there's a search for a reserve asset that's not going to collapse like debt. It's a macro bull market for precious metals. And I can't be more ardent about that. And as what everybody else also doesn't understand is when debt collapses, the buying power of the currency falls with it in the end. So they take turns, left, right. We've had a period where the debt collapsed 45%. We were short the TLT from 2020. Then you get the dollar devaluation. You see how they are alternating. Eventually, when you get to that convexity, they collapse together. It is such a key moment, and everybody needs to understand finance is about to become the most important part of your world, or you're just going to be hit by the tsunami and you're never going to know what hit you.
No. Current conditions represent an opportune time for gold investment positioning. Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. Are you prepared for a financial system where traditional safe havens like government bonds no longer offer real protection? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.